Hello, Chida. My name is Wasku Smart FX. Welcome to my YouTube channel. So this is the institutional market structure episode 6. So on today's episode on the institutional market structure, we'll be looking at a pair called gold. We'll be looking at gold, and we'll be talking on a subtopic under the institutional market structure, which is called the concept of mitigation. The concept of mitigation block. So whereby you can actually categorize the institutional market structure, and you can actually categorize the mitigation block as an institutional market structure. So which means that it has been proved and it has been approved that mitigation block is also used by the institutional market, by the banks, to take a possible entry for their positioning. So on today's trade now, I'll just do a little definition of what a mitigation block can mean and how we can actually spot a mitigation block. So before we continue, let us draw out how mitigation block look like so that everybody can be on the same page. Yeah. So okay. So let's say we have a bullish move. Market was bullish, then the market was bullish. Then it get to a certain position, then we have a changement, then market was unable to go up to the high, then market broke destruction, Okay, if you look at this pattern, we actually see that it's the same thing as the institutional market structure that we have been talking about, whereby we have a short time high, intermediate time high, and a short time high. But one thing that is different is the entry. So this today entry today, we are talking about the concept of mitigation block, whereby we'll be using the mitigation block as our entry, not the fair value gap or not the other block. So why mitigation block? Why mitigation block? I want to tell you another thing. If you look at a entry like this and you did not spot any fair value gap, I will actually advise to take a mitigation block. Mitigation block are the blocks or is the block that created the a rally high, a failed rally high. Is the block that created this failed rally high before market breaks it. So you want market to come back to it, then we can be a seller. So I was expecting market to come back to it here so I can be a seller. But don't get me wrong. Another thing is that when you have a fair value gap on top of the market, there is high possibilities that market can actually go into the fair value gap before coming down. So which means that fair value gap is more highly recommended and more highly solidified than a mitigation block. But that does not disqualify the importance and the importance and the evidence of the mitigation block. Don't forget the basics patterns or the basics POI, point of interest, for the forex market are not more than three. Number one, the support and resistance. Number two, the demand and supply. Number three, the equilibrium of prices. So which means that those are the three basic that the whole forex fundamental and the technical analysis actually rely on. Market makers are looking for where there is high demand, and they are looking for where market has high liquidity. So and they are looking for how they can lower the prices, whereby they can enter into if they can enter into a zone that is called the discount zone, or they can enter into a zone that is called the premium zone for them to continue their buying or selling. So I hope you understand this concept. This is what all forex is all about. But all these things we are doing, we are just trying to form a model around this basics technical analysis POI. So don't get me wrong. A mitigation block has an ideology of support and resistance, which is actually solidified. But when we come to fair value gap, fair value gap is actually it actually works all time because there is a gap the market needs to fill. It is called an imbalance. So let's get started. If you understand this analogy and you understand the concept, don't forget you have to have this first. Then you have this is important, followed by the uh, broken of the structure, then the mitigation block follows it. That's the three things that is important in this concept called the concept of mitigation. So thank you. Let me delete all this so we can go into the view chart and see what we want to see in the charts today. So let me just delete all this. Okay. So yeah, this is gold 15-minute chart. So you can look at the chart. Look at the chart. Don't forget our number one step for the institutional market structure pattern that we are trading is what? Number one, find market at the higher time frame POI. So before I take this trade or before I look at this trade, you see this what I wrote here. There's an order block from higher time frame 4 hours. I saw a big zone where I was expecting market to sell from. Okay, let me show you my Telegram channel. Yeah, you can see this here. So I was actually expecting a sell from the other block. This is the line that you are seeing is the other block from the higher time frame 4 hours. I was expecting a sell. You can see what I wrote here, gold 4 hours chart update, market order flow. So I was expecting a bearish. I was expecting market to go bearish. So that was what I was expecting. You can see how market was going bearish, and that is what fulfilled my higher time frame structure zone for me to be a seller. But because market wants to sell on higher time frame, that is not the reason why I sell. So the second thing I have to do is I have to follow my pattern. So what is the pattern? Short time high, intermediate time high, and a short time low. So I want you to look at the chart again. You know, I usually do it every time. I want you guys to learn. I want you guys to understand this thing. I want you guys to see it yourself. You know, that's the way. That's the only way you can actually learn. That's the only way. No way again. You have to see it yourself. You have to trade it yourself. You have to feel it yourself, emotionally, physically, anything spiritually. You have to do it yourself. Yes, it's painful. Do it yourself. Yes, you lose the money. Do it yourself. So I want you to see it yourself. See if you can see it. See if you can see it. Okay, pause your video. Pause your video. Fine. You don't pause the video. So this is what I'm seeing here. I'm seeing higher time frame. Market was bullish. Then you see market get to this extent. The market want to rally up, but market did not rally up. The market comes down. At this junction here, I was looking at this. There is a what? Market structure shift. Yeah, we have a market structure shift. Market actually shift the structure here. So which means that we are having a bullish, but at that particular point, market shift. So you are having a short time high. So this is a short time high here. So let me close it. So a short time high here too. So this is an intermediate time high. So intermediate time high. So this is what I was expecting. Now, according to the pattern I draw the other time, yeah, according to the pattern I draw, you can see something here that pattern that I draw that other time there. Another thing now is to spot out the mitigation. You can look. The reason why I said the reason why we have to use mitigation block is because there is no fair value gap. So if there is no fair value gap, the real thing you have to use is called the mitigation block. That is why I'm teaching you the concept of mitigation, because you have to understand this so you will not miss trade. You understand? Yeah. So let's continue. So that we not miss trade. Do you understand what I'm talking about? Yes. So we can look our POI from here, no fair value gap, and that is the reason why I triggered the mitigation concept, so that I want everyone not to miss out in any trade you encounter yourself with. So now we have our complete setup. Number one, the higher time frame zone. Number two, we have our pattern, which is called the short time high, the intermediate time high, and the short time high here. And market could not go above this. The market traded and break this structure. So our mitigation block, I said the definition of the mitigation block is the block that propose or trade that failed high. This is called a failed high because it could not go above this high. You can see all these ones here. Market to chase, market goes up, market to chase, market goes up. But when you get to this place, market to chase, the market was unable to go up. It is called a failed high. So here we call it a failure swing. So the block that created the failed high is what we call the mitigation block. So this is our mitigation block. So that is the particular place we call our mitigation block. So this is our mitigation. So I was expecting market to come back into it and be a seller, and my stop loss will be above here. So let me show you. Okay, okay. So I was expecting market to come back, and this is my short here. The market stop loss above it, and one to two. You know, 1 to 2 is our risk. Our risk, as always. What I always tell my students, 1 to 2 is the best risk you can ever have. Don't. I know you can have more, but always target 1 to 2. You lose one, you gain two. That's the confidence one you can have. You understand? So let me show you on my Telegram channel. You can see it here. I actually annotate this one very well because that day I was rushing. You can see market here, great. You can see what I wrote here, market structure shift. Then I was expecting market to come to the mitigation block here, which is also called the equilibrium. You can see the 50% market to come there and sell. That's what I was expecting market to do, come there and sell. So okay, let's do. So you can see, yeah. So you can see the trade. So let me show you the trade on my VIP. So you can see the trade here. You can see I entered through the open and the close of that mitigation block because I was trying to maintain my stop loss. I don't want to have higher stop loss. So you can see how I enter my trade, 1 to 2. So, and you can see, let me show you the amounts that was made. Okay, yeah. So okay, you can see it there, how market go inside it and trade low. That's 93 pips. You can see it here. This one was 99. So market trade still trade lower, but you can just take 1 to 2 and leave the trade. This is what it's called. This is called the mitigation concept. So I want you to understand this pattern to an extent that you'll be able to confidently trade it yourself. You can use gold, you can use any other currency pair you want to use. It is allowed, it works, it's universe. But you have to follow patterns and you have to follow the ideology and the principle behind this market structure strategy. It's an institutional one. Market makers, this is what they call the market maker footstep. The way they take their trade, the way they sell, the way they buy. This is one of their footsteps that market makers use. This is one of their footsteps. I want you to see it in this angle I'm saying it. I want you to be able to trade it yourself. I want you to find peace in trading it yourself. It's very easy. But I don't say it's easy because you have to study it yourself. You have to see it yourself. And I wish and I hope that all my students on my YouTube channel can actually take this trade because this trade is just this week trade. It traded on Wednesday. Yeah, on Wednesday. Yeah, okay, Thursday. It was a Thursday trade, March 14. So you can see these things is actually universal. I want you to see it yourself and tell it yourself. So don't forget to like, share, and subscribe to my channel. Call a lot of people to my channel. Share to your friends. Share to your friends. Help the channel to grow more so we can reach out to more traders. And if you want to join my Telegram group, the link is in the description. You can just click on the link and join. Um, I drop my insights, I drop what I'm looking at, so you can see the insight before it happens. You can see it yourself too. You can trade it if you like, and you don't like it, you don't trade it. That's what forex market is all about, bro. I want you all to look at it and trade it yourself. So thank you very much. Don't forget to subscribe also and drop a comment. Encourage the channel, drop a comment. Let me know you are looking at it. Let me know you are seeing this all the videos. Let me know you like it. Let me know you want it. So I can continue and more and study more and do a lot of things so that you can all see it and be profitable in your trade. That's what corporate market is all about. So thank you very much. I love you guys. Bye.